Good morning, Tom Welch with Victory Park Capital. We are a private debt and equity fund headquartered in Chicago. Key focus on the specialty finance, non-bank financial services sector really over the past 5 to 6 years. We play more on the lending side of the equation, so providing that first institutional balance sheet or credit facility to help businesses grow.
Hi, I'm Simon Champ. I'm the CEO of a business called MW Eaglewood Europe. MW stands for Marshall Wace. Marshall Wace is a $25 billion asset manager based in London, primarily focused on equities, but MW Eaglewood focuses on alternative strategies in credit, and we've largely been a pioneer of permanent capital, something that Ron talked about earlier, being an important cog for the growth of the industry.
Ryan?
Thanks. Unlike the slide here, I'm Ryan Randall with a company called Point, not Capital Markets. Point is a company that allows homeowners to sell a fractional interest in the equity of their home to an investor via a 10-year contract. We just announced yesterday our Series A that Andreessen Horowitz led. We've raised about $15 million of capital. It's a great solution for investors because it's secured interest, 12% target return, potential inflation hedge, et cetera. Prior to Point, I spent some time with one of the other marketplace lenders in the industry, Upstart. And prior to that, I spent 11 years as an institutional investor at different hedge funds and a pension.
Thank you very much. Michael?
Good morning, everyone. Michael Gilroy. I'm a principal at Canaan Partners in New York. We're a $4.2 billion early stage venture capital firm. We invest all across technology and healthcare on the equity side. Fintech is a big focus for us. We did Lending Club Series A in 2007. Also on the board of Orchard, Borrow, and Realty Mogul.
Etienne.
Yeah, hi everybody. So I'm Etienne Boillot. I'm the CEO of a company called Eiffel eCapital, which is one of the larger fund managers in this space based out of Paris. We focus on continental Europe and the US. We've deployed about $300 million across both continents in marketplace lending, different platforms. And we've made investments in equity investments in about 20 platforms across the world.
Great. Okay, so we've got a range of backgrounds here, mostly towards the lending side, is probably true, but also some equity side as well. So you've got get both perspectives in here. Let me just start on the lending side of the fence first. How do people perceive marketplace lending? Let's focus on marketplace lending for the morning. How do people perceive marketplace lending? Do they perceive it as part of the fixed income spectrum? Do they perceive it as something of a hybrid that sits between, from an asset class perspective? Where are they putting it from an institutional investor side within their portfolio mixes? And the reason I ask this is because Ron mentioned permanent capital vehicles as well. For instance, give a classic example, Simon, you've got permanent capital vehicle. And I know it's an investment trust really in the UK. And when I talk to investors, some of them are equity investors, some of them are fixed income investors. Where does it sit? What is it?
Well, I think that's you started with the phrase, what do people think of it? And
yes.
The word people it's a strange thing because it very much depends on who you are and where you sit in the investment sort of organisation. You're right, our listed product in London has been sold to equity managers, which brings its own challenges.
So would that be equity income managers more?
Equity, almost exclusively equity income managers. But interestingly, where yields have collapsed in fixed income to virtually nothing, they haven't collapsed to virtually nothing in equities. No, indeed, most companies' equities have benefited from low cost of funding. Their P&L has improved. Their ability to pay dividends has improved. So by turning marketplace loans into an equity, that's very attractive. You tap a different market to the fixed income market, but you also have a very different benchmark, which is the coupon paid for on Vodafone or British Airways or any other equity stock, not the global bond market. So do
you think that most people look at you and then they basically look at the yield on the FTSE 100, which is the UK benchmark, it could be the S&P 500, and they go, well, I'll get a couple of extra percentage points on the S&P, I'll have you?
Yes, okay. I do think that's. I think that's what they seek diversification away from banks. They see you as a financial, which is why our share price goes up and down sometimes when financial. But they also compare you, because that's their benchmark and that's their world, with the yield of other listed equities. Whereas probably what we want to do is actually go and appeal to the fixed income manager, but he traditionally has had a liquidity historically has had a liquidity question mark about the scale of our industry, which I'm optimistic will change.
I'll come to Etienne in a second about that because I think Etienne will have some interesting views. But Tom, do you find that people look at VPC, because you've got permanent capital vehicles in the UK as well, but around the world, do they effectively just rate you off equities? That you're not really a fixed income vehicle?
I mean, I think we're more of a hybrid bucket as a platform. Similar to Simon in the UK with our UK investment trust, that's much more of a yield play. But I think generally, our strategy offers folks just enhanced yield over and above, I think, what they could get elsewhere with arguably a little more security, given how we like to structure a lot of our transactions.
Yeah, Etienne, what's your view on this? I mean, you set up your fund. You're much more consciously going after fixed income investors, really, aren't you? And in fact, you've tried to appeal to the firm that you partner with is traditionally a fixed income firm. So what's your take on this? Is it being put in the wrong box?
Well, I don't think that. I mean, it seems to me that if your underlying is fixed income, no matter what you wrap it in, it's still fixed income.
Yeah.
So we try to stick to that premise, and offer our investors a very steady, relatively attractive return. I think one of the things that we learned this year among the institutional investor group in continental Europe is that if you start to talk to pension funds and major insurance company, you've got all sorts of regulatory requirements of what they can and can't invest in and what fits into what bucket. And this asset class, even though it is fixed income, it's all level 3 fixed income. It's all non-traded. It's no CUSIP, no public markets. And therefore, it looks to them a lot like private equity.
Yes, I was going to say.
And it certainly doesn't look to them like any form of equity. I think, Simon said, it really depends on who you're talking to. If you're talking to very large pools of capital, people who want to write 50 million euro checks, they're going to look at it as a private equity type investment with a fixed income return.
Just talking to you guys, take a more equity point of view, do you think that this debate around which box it sits in, do you think it really matters? Because the reason I suppose I am dwelling on it is because it does impact the performance of the sector. Because as Ron said, the sector it still needs to grow at a phenomenal pace.
If I can just jump in, it absolutely matters because if you want to unlock significant pools of capital, every insurance company in Europe has an allocation, what they can invest in, and sort of capital ratios they have to maintain, and risk-weighted assets they have to maintain, and being able to convince them that this attracts a lower cost of capital is important, and it's very difficult.
Absolutely, and I'm absolutely echo that because one of our keynote speakers later on today, Jeremiah from SQN, his exact point is that he's made most success with dealing with the insurance companies and trying to assuage their concerns about how you look at this as an asset class, and that's where it's worked. What do you guys think? Do you think it really matters, or is it just an academic debate about where you stick it in a portfolio, Michael?
Sure. Yeah, I mean, it certainly matters insofar as that side of the equation in the marketplace that Ron was just alluding to needs to exist in order for a business to be there. Our investment process is fundamentally different. We're looking for companies that are first or close to first and can build a long-term competitive advantage, or a moat around their business. So the capital side of the equation matters, but we don't really care where it's classified. So
I suppose, I suppose the underlying question is: do you think the industry, from a VC perspective, do you think the industry will ever get to critical mass to be able to really be 10, 50, 100 billion pound companies? Going back to Ron's point, Boeing is worth, I don't know what Boeing's worth at the moment, hundreds of billions, I'm guessing, yeah? Is it not? Is it tens of billions? Not even that. It's less than 100, okay, but it's still a big number, and that's infinitely bigger than any of the businesses that, one business or 2, 3 businesses listed on the US market at the moment. So it's still, the marketplace lending business has got to scale up, and if it's still being regarded fundamentally as an equity play, to Bob Simon's point, it's never going to scale up, is it? No, it does.
I mean, I think it's really your x-axis is important there, right? Like what was Yahoo in 01 versus 05 versus 16?
Yeah.
Right? So I actually want to go back. I think it's a much more meaningful discussion around portfolio construction that you're getting to.
Yeah.
I mean, when you get to these larger pools of capital, how Norges looks at it versus how GIC looks at it versus like state of Florida versus CalPERS. It's all very inconsistent, right? They look at equity, they look at fixed income, they look at alternatives. So I think what's important is creating clear returns with like a very consistent standard deviation of those returns, right? I mean, you can, whether it's, you're calling something equity with dividends and the bond market sells off over the last 2 days of last week and you lose a whole year of dividends, right? And that shouldn't happen. But allegedly there's 12 trillion of kind of sovereign debt trading at negative yields. So I think you need to, until there's more track record in the industry, right? You need to, I think that an alternative is a better place to put it, right? Because these largest pools of capital are going to need their consultants to get copacetic with the return stream, and then they can start deploying things in size.
It's probably worth saying, I'm quite excited about I'm generally excitable, but I'm quite excited about the future because the one thing, part of the reason that in my case, Eaglewood started with permanent capital in an equity format was because permanent capital works well with the platform. He likes that visibility, as Ron said. He wants to know where the money's coming from. Historically, in fixed income, you had very liquid funds with redeemable capital where people could change their mind, and that doesn't work brilliantly with a platform. The bit I'm excited about is we're beginning to see, and lots of pension funds I've met in the last year are beginning to set up parts of their business where they're fixed income, but they're also increasingly accepting illiquidity or accepting some form of permanence of the capital or locked up capital or longer duration capital. That is massively exciting because if you can persuade pension funds to lock up some of their money in a fixed income, often on the fixed income desk, but lock it up for 7 years or 5 years, then that will release huge amounts of capital. And that's happening now because yields are so poor, they're having to do that to get yields.
But then does the vehicle, sorry.
We've actually done that. We raised a €100 million 10-year fund. So it's not equity, but it's semi-permanent capital. And
isn't
it's
it private
locked
equity?
up.
It's private equity, isn't it? It's a private equity fund.
It's a private, but it's investing in this sector. And
It's a private equity structure, right? It's not open, which mitigates the liquidity issues.
Which brings us to the question of structure. So again, we started the conversation at permanent capital vehicles. The problem with permanent capital vehicles, of course, is that if they're listed on the stock market, their share price goes up and down. So correct me if I'm wrong, both of you are around at 80p in the pound at the moment, something like that? Yeah, a bit higher, 82, 83. Now that, for a lot of pension fund managers, is going to be a real problem, isn't it? Because effectively, they've got to get their head around the asset class, and they've got to get their head around your vehicle structure. Isn't it better to go an open-ended route? Is it better to directly invest in platform? What's your take on that? I mean, I'm guessing you will say permanent vehicle route, but it does have, your share price is going to go down, and that is a problem for a lot of your investors.
I mean, I can't comment specifically on our shares, especially in the US. I'm not allowed to talk about them, etc. But the nuances of investment trusts listed on the stock market is a whole science in itself.
A very peculiar science.
Very related to delivering on the income, ultimately.
Yeah, exactly. Yes.
And if you deliver on the income, then I'm pretty confident that you will achieve that. I think it's a challenge to deliver it instantaneously, and the equity markets are notoriously sort of short-sighted. They're not. What's the word? They want their cake very quickly. But long term, I'm very confident that we can trade back at par or indeed a premium. But ultimately, I still think permanent capital of what Etienne has done is very exciting, and I think you'll see other funds, indeed like ours, sort of bring similar vehicles to the market, bridging that gap.
Sorry, Ron,
Yeah, I think it's a function of the underlying, right? And when you talk to investors, you have to get them comfortable with the idiosyncratic nature of the risk and returns, right? If you have like a 3 to 5 year average life with these permanent funds, what we do in Point, we put our options in a closed-end fund that's roughly 10 years. Okay. And capital will return after 3 or 4 once we start to see homeowners repay these options or sell their homes. But it is a longer duration, so it's more appropriately suited for a closed-end vehicle versus something that's going to require liquidity and intervals. And that's where you create that pricing challenge, as you mentioned. You pay for liquidity, but then you have to determine the value of the assets very frequently. So you can get myopically focused on a price that may or may not matter for your long-term objective.
Michael, from an equity perspective as well, we've seen also the growth of different forms of accessing, so like Orchard, who got their own method, kind of specialist access platforms. Do you think that the real growth of this market is going to come from the permanent capital guys? Is it going to come from more the kind of PE stroke, kind of more open-ended fund, traditional fund structure that maybe Etienne's trying to do? Or do you think it's going to come via people who can basically make institutional access really easy? Where's your sense in that debate? Because that really does matter, that access point. It really does matter.
Yeah, so as I mentioned, we invested in Lending Club in 2007, and we started to see this pretty early on, and very quickly shifted from a peer-to-peer, your Facebook friends are funding your loans, to accredited investors, and then it's institutional investors, and the whole marketplace piece kind of fell out. We saw that, and we invested in Orchard. So I think by virtue of that fact, it kind of tells you a little bit where we think the market is going. I think it's going to be a combination of all of the above. Okay. I think Orchard and some of the other folks are going to play a very key role in the marketplace. The analog we like to use is ad tech, and you have exchanges that sit in ad tech, and the ad units are traded just like loans are. And for us, that's really where we see the market going. And you go back to the standardization of data that Ron was also just talking about, which is another very key piece in order to get there.
We've got a couple of questions, and I would encourage everybody...
Can I add one thing real quick?
Actually, can I just encourage everybody to keep putting questions in via the microsite? Because we've got a couple coming in already. Yeah, Ryan.
Yes, please ask lots of very good questions.
Yeah.
If I look at the analog of kind of the hedge fund industry where I spent 10 years, right? Usually you could get two portfolio managers in a Bloomberg and you grow in 25, 50 million in the early 2000s, right? Then there's this thing called Bayou, there's this thing called Stafford, and then Bernie Madoff. Right? Then all of a sudden you needed a CEO, you needed a COO, you needed to spend $1 million and have an institutional grade compliance desk before you're going to get any allocations. Right? So 25 became 250 to 500 million. Right? So what DV01 is doing, what Orchard's doing, what PRIQ is doing is critically important. Right? Because if you can't understand how your returns are being calculated and the risk of those underlying returns, you're not going to get large pools of capital, particularly, as Ron noted, without derivatives. Right? Because the more you can hedge, the more you can deploy capital. So that's just an observation.
Just a couple of quick questions here. Jason's asked, what types of firms are the most likely to provide committed capital to the platforms? And what's the expected cost of those funds? So I'll start with you two and then come over to Etienne. So what kind of people are investing in you guys? What are they expecting? Are they expecting 6.5, 7?
I think it's totally risk related. I think, and that's one of the things where the industry perhaps has a little bit more explaining to do, and as time goes by, investors will understand that some funds are different to others in terms of risk. So just looking at the coupon is definitely not the answer, because we take different risks. There are 3 or 4, maybe 5 now listed vehicles in London. They all buy different things. It would be totally the wrong answer to expect them all to create the same coupon.
What are the kind of vehicles, just to take the first point, who are the kind of people buying you at the moment, just to that factual point? Are they mainly, you said earlier, they're probably mainly equity income? Yeah,
but in the case of Eaglewood's listed fund in London, it's exclusively London investors, exclusively equity investors, all 95% institutional, and then a little bit of retail.
Multi-asset managers, wealth advisors?
A little bit of multi-asset, but mostly pure income-orientated equity people.
Okay.
Yeah, I think in London with the UK investment trust market, it's extremely niche. It's extremely small. You have extremely, you're not getting, I think we have less than 5% of holders in the US in our UK investment trust. So it's very nuanced to the London market. I think from Victory Park's standpoint, we've been attractive to, large sovereign wealth funds. We've been successful in raising some large funds of one where we're getting allocations from their alternatives bucket. Structured as those drawdown private equity vehicles, so again, kind of quasi-closed-ended capital. But our hurdle rates remain high, and I think that's why I think we need to price things where we do, is because people aren't coming to us with a 6% hurdle rate because we're in that alternatives bucket, and therefore we've got hurdle rates much higher than that.
It's a follow-on question for you, Etienne. Question here from Daniel. What effect would a bond market crash have on your funds? So those categories do matter, don't they? Because basically if you're regarded as part of fixed income and you get caught up in the fixed income potential meltdown that might happen, who knows? It's been predicted for many years. Or will it behave more like an equity, and it will behave like, as Simon said, and will move up and down with the S&P and the FTSE 100? So what effect will the bond market crash have?
0 on our funds, because we're not listed. And
The beauty of the PE method, I suppose.
yeah, I think that the real question, the question behind your question is a really important one in the industry, is valuation.
Absolutely.
And Ron mentioned this, and we all know this. There are as many valuation methodologies out there as there are funds, and as there are accounting firms, and that just has to stop, because it's extraordinarily confusing for investors. If you know, sophisticated fund managers in this industry, whether they're in the UK or the US, are using different valuation methodologies for the same underlying loan from Prosper or Lending Club or whoever, or Funding Circle, then we've got a problem, and I think we need to address that.
Ryan, what's your take on it? You come from an institutional perspective and hedge fund land. I mean, you know, everybody's been predicting the bond market crash for absolutely ages. If it happens, do you think it's going to waylace the entire industry?
Yeah, I mean, I think Etienne made a very interesting observation about a need for industry standards, right? I mean, people are starting to get involved in DC. I think we'd be very well served to actually have industry standards on data, right? Just then you have consistency. You know, as to the bond market sell-off, there's something called relative value. So if anything has a fixed income component and the underlying treasury curve of G20 country sells off, then unfortunately anything fixed income related is also going to sell off, whether people believe in it or not. That's just kind of how the markets work. And when you have level 2 and 3 assets like these, you're going to be comped to level 1 assets that trade, which are predominantly fixed income. The challenge here is that, you know, with equity markets and fixed income markets at all-time highs, there's really nowhere to go.
Yeah, I was about to say.
Right?
Yeah.
So, you know, no one liked
And in
when...
sell-offs, they're all autocorrelated anyway.
Well, I mean, when Draghi didn't, you know, bring another punch bowl, people got a little nervous, right? And then you get the FOMC talking hawkish, and people get even more nervous, right? The ISM 2 weeks ago was contractionary. But, you know, we're long outside the realm of kind of normalcy, right? We're kind of flying a plane without instruments. So, I mean, that's a much longer conversation for much smarter people. But I think the challenge is that, you know, there's going to be forced selling, and if you don't have a particularly liquid product, it's going to manifest itself in price. So that's something we're all beholden to, and not particularly liquid product.
Another question here. Do you think investors are buying back loans at par, or are they becoming permanently addicted to incentives from the big platforms? Who wants to answer that? Simon. Tom.
Thank you for that.
Thank you. Tom, you're next, don't worry.
I don't think incentives and discounts, etc., that we've seen in the last few months following lending clubs issue, we didn't build our funds based on receiving them. We certainly didn't anticipate them. So for me, I think I really actually genuinely hope that they're a temporary phenomenon, because it's a sign of health of the industry. And I think when someone, as Ron said earlier, you suddenly lose half of one side of your balance sheet, then you need to do something to maintain that. But I don't think it's a permanent feature.
Yeah, I would agree. I mean, I think it's purely a supply and demand issue, and you know, something that manifested, you know, I would argue kind of Q3, Q4 last year, when you really saw the demand pull back and the supply and the growth curves continue. That, you know, layer on top the contraction in the ABS markets, or blowing out of the ABS markets, I should say, really just compounded that effect. So I think what we saw the first half of this year was really just the first kind of quasi-correction in the space.
Sorry.
I mean, it echoes the relative value comment, right?
Yeah.
Q3, Q4 last year, credit markets blow up. Hedge funds can buy a broken RMBS bond or a structured bond and put it on margin with their prime broker, or they can buy this, and that thing's 200 points wider. They're probably going to take a harder look at that, right? So people need to be very cognizant of relative value for determination of pricing returns.
Ryan mentioned, I'm going to end on what we need to do to move forward in terms of standards. You've already mentioned data, consistency across data. What are the other kind of areas that people really need to think about in terms of standards for the industry moving forward? Again, Ron, I think, pulled out some of those issues himself. What are the crucial ones for you guys?
I thought, actually, I enjoyed Ron's 9, but I felt it should have been 10. I thought he missed one. Because I think probably everyone on this table these seats is on the right side of this equation. But I think operational excellence is going to effectively increase amongst asset managers, because the asset class is increasingly complex. Leverage makes it complex. Duration makes it complex. And I think one of the great things about what Etienne was talking about earlier, about bridging that gap and attracting really serious long-term capital from fixed income investors. That's a great thing, but the other side of that is they have extremely high standards of operational excellence, and we will all be heavily due diligence, I think, in the coming years. And it'll mean fewer managers make it through that net. And I'm excited by that because I think the better guys come through that.
You assume you'd be one of them anyway.
Oh, well, I certainly hope so. But it's like most industries, as they start with lots of players. I think, again, Ron said, you said there were too many platforms. Not many funds, I don't think, in 5 years' time will make it through that due diligence.
Yeah, it's interesting to hear you talk about that from the fund side because it's something we talked about for a long time on the originator side. You look 3 or 4 years ago, there weren't that many players, and 24 to 12 months ago, they were popping up every other day in our offices raising an equity round. And having seen a number of them come through, we really, we're telling folks operational excellence is what you're going to need to move forward here, and that's underwriting, so on and so forth. So it's good to see, the true kind of fintech players building companies as opposed to the Google, Amazon, engineers with the pitch book.
Etienne, what other things in terms of standards? Ron mentioned an awful lot about dealing with kind of enterprise risk and regulatory risk and all those kind of issues, and I think Simon's just emphasised this. You must go through a lot of hurdles when dealing with a lot of the kind of big European pension funds and insurance investors, because, as you said, they really do need to cross the T's and dot the I's, don't they?
Yeah, I think that's right. I think the other challenge is regulatory. We have a hodgepodge of regulation, whether it's in the U.S. or across Europe. It's not consistent. It's not consistently applied. We feel this very acutely in Europe because we're dealing across multiple jurisdictions, and it's a real problem. And if this industry, as Ron said, is supposed to solve the financing, is to help part of the solution to the financing of small businesses across, whether it's the U.S. or in Europe, which is a real problem because the banks aren't lending anymore, then we need the conditions to be right for institutional investors and their conduits, us, to be able to operate effectively, and having uncertain regulatory environment is not helpful.
Tom, what do you think? What do you think are the kind of key things moving forward? We talked a bit about data. We talked a bit about regulation, operational excellence. Is there anything else missing off Ron's list of 9? Should it be 11?
Look, I think it's a conglomeration of all those things. I really do. I think while everyone in this room, intimately involved with this space, and while this may have changed with all the press lending club got over the last 6 months, I think your average person is still. We have multiple intro meetings where we're still educating knowledgeable big name firms about what's going on in alternative finance.
So education almost.
I think education, just in awareness, but I think a host of these things. I think regulatory issues. I think it was the first time it was mentioned in this panel, but I think that's one of the key issues of getting some clarity in the U.S. True lender risk, Med and Midland, all of the things that the CFPB are up to. The jury's still out there, and until there's clarity, I think that's going to be a big gating factor to getting a lot of the institutional money flowing in.
Finish with you. Is there anything else you need to add to this shopping list of things that the industry needs to get right in terms of standardization?
No, I think Tom made a good addition with regulatory. It's going to be pretty boring from that perspective. This is just kind of blocking and tackling, right? To use an American football analogy, you're just running between the tackles inside the red zone, right?
I have no idea what you're talking about.
Yeah, is that the ball? That's not the round ball, is it? No.
Yeah. There's just this Super Bowl thing. You might have seen it. It's execution, right? It's like Tom mentioned, there have been some ridiculously self-inflicted wounds that could have been avoided time and again for this industry in the spring, right? And it's atrocious. The takeaway there is that hubris is a horrible strategy for financial services, be it long-term capital, be it Lehman, et cetera. So it's going to make the industry stronger, and people just need to execute, right? And if you have consistently strong execution, then the capital is going to flow, and things are going to work out as people had expected.
Lovely. We're going to finish the panel there. They're going to be lurking around, I think, for a few more hours. You can always ask them some more questions. I keep reminding people send in their questions. We will put them in the panel. And in the meantime, we're actually going to pick up some of those issues in our next keynote with Rupert. He's going to talk a bit about transparency. But in the meantime, put your hands together for our first panel. Thank you very much.